Good morning, everyone. My name is Ignas Ananda. It is a very great opportunity to welcome you this afternoon. I would like to say thank you for joining us today in this international online seminar about COVID-19 and its impact on the financial services sector, an issue that we are facing together these days. This seminar is held by BINUS University's Accounting Study Program together with Tunku Abdullah Rahman University College. First of all, I would like to welcome Dr. Chow Yee Peng as our speaker today, Associate Professor Wong Hua Kiong as Dean and Associate Professor from Faculty of Accountancy, Finance, and Business, Tunku Abdullah Rahman University College, Dr. Chin Mu Yin as Deputy Dean and Senior Lecturer from Faculty of Accountancy, Finance, and Business, Tunku Abdullah Rahman University College. I also want to extend our welcome to Dr. Arianti Puspokusumo, Bachelor of Science, MBM, as Head of Internationalization and Partnership Program, Faculty of Economic and Communication, BINUS University, Pak Kevin Deniswara as Deputy Head of Accounting Study Program, BINUS University, Bu Shinta Amalina H, SA, MBA, Ph.D, as Faculty Member of BINUS University. Also, I would like to welcome all the staff and students from BINUS University and Tunku Abdullah Rahman University College. Regarding Zoom security issues, I want to inform you that we use a licensed Zoom and we enable waiting room and filter out participants and audience who join in this event. And make sure you install Zoom through the official website. As a reminder, for all staff and students from BINUS University, please write the name in the specified format, student or employee ID, strip name. At this time, I would like to welcome Dr. Arianti Puspokusumo, Bachelor of Science, MBM, as Head of Internationalization and Partnership Program, Faculty of Economics and Communication, BINUS University, and Dr. Chin Mu Yin as Deputy Dean and Senior Lecturer from Faculty of Accountancy, Finance, and Business, Tunku Abdullah Rahman University College for opening speech. Please welcome Bu Arianti Puspokusumo and Dr. Chin Mu Yin.
Thank you so much, Ignas, for this. Ignas is a student, I think. Yes.
Yes.
You've done very well. I would like to take this opportunity to thank Tunku Abdullah Rahman University for supporting our activities in the Faculty of Economics Communication series of webinars. For this, I have to thank Professor Say Sokwan as the main collaborator of this event. And for that, I have to thank also Professor Wong Hua Kiong, as well as Dr. Mui Yin Chen as providing all these lectures for us for this past 2 weeks, for us to give a speech before the students. To Dr. Yee Peng, Dr. Chow, I would like to thank also your availability and cooperation for today, so that we can have this webinar to be done in such an honor. Dr. Chin, again, sorry for bridging between us together, so that the speaker, both last week, Professor Kung, Dr. Kung, and Dr. Chow can be available today. So on behalf of BINUS University and the Faculty of Economics and Communication, I really extend my thankfulness for this. I hope that we can collaborate again in the future for any what they call it, a one step ahead of this, maybe an exchange of students. We've been sending also students to your university since especially accounting students. We sent 17 students from Bekasi to attend your seminar last year, and that was also a very good one. And for this, I'd like to give the floor to Professor Wong Hua Kiong to say a word or two on behalf of Tunku Abdullah Rahman University. Thank you. and Professor Chin as well. Hello?
Hello, yeah.
Yes.
Maybe I say something first. All right,
Yes.
so I am Moyin from Tunku Abdul Rahman University College. I am the Deputy Dean for Faculty of Accountancy, Finance and Business. And indeed, this is an honor for us to work together with BINUS University to have this series of seminar. We are very happy to share our knowledge with the students and staff. And we hope that in the future, we have more of this kind of collaboration and we can extend our collaboration in other areas such as exchange of staff, exchange of students, or we have collaboration in terms of research. And we also look forward to visit BINUS University and we look forward you all to come over to Thai UC so that we can have face-to-face meeting when this COVID-19 pandemic is over. Okay, so with that, thank you for giving us the opportunity to collaborate with you all. And maybe my dean, Associate Professor Wong would like to say a word or two for this seminar. Thank you.
Yeah, I just have to, I would like to take this opportunity once again to thank BINUS University to actually work together with us so closely to provide such a good platform for students and staff to share the knowledge and the experience. So as what Dr. Chin said, we actually look forward for more collaboration in the future. And also, I think in terms of staff, I think not only for students, I think such collaboration, we actually hope that to extend to our staff as well. So I'm looking forward for that. So once again, thank you very much for all the efforts and the opportunity given to Thai UC to work together with BINUS University. Thank you.
Okay, thank you, Bu Arianti Puspokusumo, Dr.
Thank
Chin
you.
Nguyen, and Professor Wong Hua Kiong for the opening. Moving right along, it is now my pleasure to introduce our moderator, Bu Shinta Amalina H, SA, MBA, PhD. Let me introduce a brief highlight about Bu Shinta. Bu Shinta got her bachelor's degree from Presiden University Indonesia in banking and finance and continued to pursue her MBA in corporate finance and PhD in financial management from Wuhan University of Technology, China. This PhD got Bu Shinta Muri record as the youngest woman PhD holder from Chinese University in 2018. She is now a faculty member of BINUS University, specializing in finance programs. Please welcome Bu Shinta Amalina H.
Okay, thank you, Ignas, for your introductions. It is very my pleasure to join and to be trusted as a moderator today, this international seminar. And we know that Tunku Abdul Rahman University and BINUS University has a such great relationship. So this international seminar could be conducted. So to keep our time better, as it shows almost 1 p.m. now. So I would like to tell all the participants that actually we have around 900 registered participants and it's already around 600, almost 700 participants here. 700 are from BINUS University and another 200, I guess, from Tunku Abdul Rahman as well as from external, because this international seminar is an open public. So I also would like to introduce our honorable speaker from Tunku Abdul Rahman University. Let me brief you in brief introductions. So our speakers, Dr. Chow Yee Peng. She is a PhD holder, also a senior lecturer at the Faculty of Accountancy, Finance and Business in Tunku Abdul Rahman University College. She has almost 20 years experience of teaching, experience in various finance-related courses at both undergraduate as well as postgraduate levels. She's also actively worked in her research, published in various referred journals as well as conference proceedings, both internationally and as well as locally. She is also a reviewer for national as well as international journal, and she is a specialized in banking industry, both local and foreign commercial banks, serving in various capacities, including treasury and credit management. So for her education background itself, she took her Doctor of Philosophy, which is that graduated in year 2017 from Putra Business School, University Putra, Malaysia. And for her Master of Business Administration, graduated in year 2004 under Faculty of Business and Accountancy, University of Malaysia. Both are concentrated in finance. So she has a lot of journal publications as well as Scopus Index, and also conference proceedings as well as activities achievements that she have. So here I would like to welcome Dr. Chow. And before we conduct our seminar, before we place the time for Dr. Chow, I would like to guide the audience that you may drop your questions to the chat box, and I will try to select some questions, and I will open like 3 questions for the first sessions, and you may ask in Bahasa or English. If you happen to ask in Bahasa, I will try to translate it as well. So don't worry, don't hesitate to ask, as take this opportunity to gain more knowledge, as this is an international seminar, and I guess this is one of the biggest international seminar conducted by accounting department, because it is registered for almost 1,000 participants. So the floor I give to Dr. Chow Yee Peng for around 45 minutes to deliver your sessions. For the time is yours, Dr. Chow.
Thank you, Dr. Shinta. Can you hear me?
Yes, it's very clear here.
Right, I think I will start my slides first.
Of course, you may share your slides.
Okay. Can you see the slides?
It's now. It's out now.
All right. Okay. Let me open it first. Okay, a very good afternoon to everyone in Indonesia. Greetings here from Malaysia. I'm Dr. Chow Yee Peng from Tunku Abdul Rahman University College. Thank you for having me here. I'm very honored to be invited as your guest speaker today. Today, I'm here to share with you a lecture on COVID-19 and its impact on the financial services sector. In January 2020, the World Health Organization, or WHO, identified the root cause of an influenza-like outbreak in the city of Wuhan, China. Known as the novel coronavirus or COVID-19, this highly contagious disease has spread rapidly throughout the world. As can be seen from this world map, all the areas shaded in red are countries with confirmed COVID-19 cases. As at 19 May 2020, which is yesterday, there were a total of more than 4.8 million confirmed cases worldwide, with more than 318,000 reported deaths. The COVID-19 outbreak has created considerable sufferings for mankind and has caused disruptions in our daily economic activities, as many countries around the world have imposed certain forms of social restrictions, such as lockdowns, restricted movements, or even curfews. According to the Organization for Economic Cooperation and Development, or OECD, if this outbreak prolongs and intensifies, global economic growth could decline to a mere 1.5% this year. Moving on to today's topic, how does COVID-19 impact the financial services sector? I shall focus on 4 main institutions in the financial services sector, namely banks, investment companies, insurance companies, and other non-bank financial institutions. First, How does COVID-19 impact the banking institutions? Firstly, it can be observed that bank regulators in many jurisdictions around the world are relaxing their banking rules. For example, on 27 March 2020, the Basel Committee's oversight body has endorsed a set of measures involving changes to the implementation timeline of the outstanding Basel III standards. The aim of these measures are to provide more operating capacity for banks and supervisors to enable them to better respond to the immediate financial stability priorities of the global banking system. Before that, let me give you an overview of Basel III. Basel III is an internationally agreed set of measures developed by the Basel Committee on Banking Supervision in response to the 2007 global financial crisis. And these measures aim to strengthen the regulation, supervision, and risk management of banks around the world. As can be seen from this table, here is the list of Basel III standards and the original implementation date. Due to the COVID-19 outbreak, this implementation date has been revised and postponed to 1 year later. Now, some may be wondering, will there be any implications due to the delay of the implementation of these standards? Well, according to the Basel Committee, this revised timeline should not affect the capital strength of banks because these are revised guidelines and they are used to complement the original or initial set of Basel III standards that were already in place. Besides that, other countries have also relaxed their banking regulations. For example, in the European Union, the European Central Bank has announced a series of measures to allow banks to fully utilize capital and liquidity buffers, as well as to provide reliefs in the composition of capital for the purpose of meeting Pillar 2 requirement of the Basel framework. Now, what does this mean? This means that banks are allowed to operate temporarily below the required level of capital under the Pillar 2 guidance of the Basel framework, as well as the capital conservation buffer and the liquidity coverage ratio. The second impact is declining bank profitability. Banks' profitability will be under pressure due to several factors. Firstly, it is expected that banks will suffer from reduced offtake of loans, as it is expected that there will be a slowdown in loan growth this year. Secondly, banks is expected to experience an increase in loan delinquencies or non-repayment of loans after the moratorium period. I shall talk more about the moratorium period shortly. And thirdly, banks' profitability could also be affected due to depressed net interest margins or NIMs due to the low interest rate environment that the banks are currently facing. And I shall also talk more about this situation shortly. And the fourth factor is there is a fall in transaction banking income due to lower cross-border trade, since there is a slowdown in international trade and many countries are closing their international borders. And the last factor is banks are experiencing a decline in fee income due to lower consumer spending, a decrease in asset management activities, as well as a slowdown in investment banking transactions. Now, having said that, these adverse effects could be partially offset by lower cost of funds. For example, lower deposit rates due to the low interest rate environment. I shall talk more about the low interest rate environment now. Initially, due to concerns over the lack of affordable liquidity in the international credit markets, central banks around the world have responded to this predicament by slashing interest rates in a desperate attempt to stimulate the economy. For example, in the US Federal Reserve, in its first emergency move since 2008 global financial crisis, has cut the federal fund rates by 50 basis points on 3rd of March this year. And then again, there was another cut to almost zero on 15 March. In the case of US, the NIMs of the banks could further decline due to a flattening yield curve. For example, the spread between long-term and short-term treasury instruments, such as between a 10-year and 2-year treasury instrument, is now close to zero, as compared to above 1% in 2015. As a result, when banks want to reinvest any proceeds from maturing loans and securities, they have to reinvest these funds at lower interest rates, therefore resulting in lower NIMs. As mentioned earlier, another factor that could contribute to a decline in banks' profitability is the increase in loan delinquencies. For example, according to S&P Global Ratings, it is estimated that Asia Pacific's banking's non-performing assets, which are made up of non-performing loans and other impaired assets, as well as credit losses, which reflects the bad and doubtful debts of the banks, are to increase by $600 billion and $300 billion respectively this year, primarily due to the COVID-19 pandemic, as well as other accompanying factors such as the oil price shock and market volatility. Furthermore, a slump in demand in various economic sectors such as auto, aviation, building and construction, retail and restaurants, gaming and leisure, and increasing unemployment will contribute further to the decline in credit quality and rising loan defaults. The third impact is banks are currently experiencing a temporary suspension of loan repayments. As mentioned earlier, governments and banks around the world have introduced payment moratoria, or the temporary suspension or delay in the repayment of loans. This is to ensure that banks can continue to lend to households and businesses, as well as to reduce the negative effects of COVID-19 on the economy. For example, in Malaysia, the Central Bank of Malaysia has required banks to grant an automatic 6-month moratorium on all bank loans except for credit card balances to assist vulnerable borrowers, particularly individuals and SMEs who were affected by the COVID-19 outbreak. Meanwhile, there were also banks that went the extra mile to assist their borrowers. For example, in the case of Italy, banks have developed frameworks to assess which proactive actions may be more effective on the clients. Here, banks would consider a few factors. For example, the level of COVID-19 impact. For instance, bank would assess which geographical areas in the country that are most affected by the virus. Secondly, banks will also look at the type of loan. For example, between a primary and secondary home mortgage. And thirdly, banks will also consider the stage of delinquency of the borrowers. These considerations and segmentation allow the banks to effectively prioritize the cases of their borrowers according to their criticality. For example, clients which are most affected by COVID-19 and have a primary home mortgage will be given the highest level of priority. Another case is Japan, where financial institutions have been examining their borrowing companies' circumstances and providing the necessary assistance to their borrowers. Besides that, financial institutions in Japan are also required to firstly determine the business conditions and short-term cash flows of their borrowing companies in even greater detail. Therefore, financial institutions have to perform actions such as site visits to their clients' premises, as well as to set up emergency consultation desks. Meanwhile, for cases of existing loans, financial institutions are required to follow up carefully on the circumstances at their borrowing companies, as well as to be quick and flexible in changing the loan conditions, such as revising the terms for principal or interest repayment. And thirdly, in the case of new loans, financial institutions are required to implement emergency lending programs and to be more flexible in their requirements for collateral and guarantee. The next impact is due to the COVID-19 pandemic, banks have relied more on the digital channels. In response to the need for physical distancing and the closure of bank branches in several locations, it can be seen that customer activity has shifted away from branch visits or in-person transactions to digital channels and online banking. For example, a survey by McKinsey & Company report that customers in banking institutions in Italy and China are more ready to adopt remote channels and digital offerings. Unfortunately, as banks move towards the digital platform, it is also likely that banks will be exposed to increased fraud and information security risks, as opportunists may exploit this situation to commit financial crime. Therefore, banks would have to beef up or strengthen their risk management practices, including by alerting their customers on the risk of scams and to encourage their customers to immediately report any suspicious activities or notices. Next, we look at the impact on investment companies. The main impact would be due to the COVID-19 outbreak. The stock market has experienced more volatility, and this has resulted in lower investing activities by the consumers, and subsequently, this has affected the revenue and profitability of the investment companies. The COVID-19 outbreak has created great uncertainties to the global capital markets. However, initially, in January and February this year, even though the COVID-19 pandemic has intensified, interestingly, the global equities market continued to be bullish. For example, in the US, in February 2020, the Dow Jones Industrial Average or DJIA, Standard & Poor's 500 or S&P 500, as well as NASDAQ, reached their new all-time highs. Similarly, other leading international equity indices also did very well, such as the UK's FTSE 100, France CAC 40, and German DAX 30. However, some cautious investors have started to switch to safer investments, especially in gold, to hedge against the risk of COVID-19. And this has resulted in the increase in the price of spot gold from January to mid-February this year. However, on 24th February 2020's trading session, reality began to sink in as the global markets began to violently price in the widespread fallout from the COVID-19 pandemic, as the pandemic dominated news headlines, as well as there were concerns over the ability of governments worldwide to contain the outbreak. At the same time, investors were also very worried about the possibility of a deep global recession. For example, on 23rd February 2020, surprise reports from Italy showed that the spread of the COVID-19 outbreak was indeed serious and could possibly threaten the entire European Union. And this has resulted in the Italian government to lock down many towns in Italy, involving thousands of citizens. On the next day, investors reacted to this news, and this has caused volatility in the equity markets to reach a very high level. For example, in the US, the DJIA lost 1,031 points, which was its worst performance in over 2 years. Similarly, other international equity indices also fell dramatically on that day. Conversely, traders and investors have switched to safer investments, especially in gold and US Treasury. And this has resulted in the good performance of these investments during the corresponding period. These are charts showing the stock price performance of major equity indices around the world, particularly DJIA in US, FTSE 100 in UK, CAC 40 in France, DAX 30 in Germany, as well as stock markets in the Asia Pacific region, which is the Jakarta Stock Exchange Composite Index in Indonesia, as well as FDM KLCI in Malaysia. And from here, we can see that this stock price performance of these major equity indices tend to move together. For example, in January and early February this year, even though there were concerns over the intensity of the COVID-19 outbreak, investor sentiment remained bullish, and this has contributed to the good performance of the stock market. However, on 24th February, reality began to sink in and investors started to panic, and this has resulted in a stock market crash around the world. After this particular date, even though we have seen that there is a rebound in the stock market, volatility continues to persist until today. So how does this volatility affect the investment companies? This has affected the revenue and profitability of the investment companies. For example, due to lower trading volumes, this has caused a decline in brokerage fees, such as commissions. Moreover, profitability, especially for retail securities firms, which normally make a significant portion of return on the uninvested cash balances of their customers, will suffer due to the low interest rate environment. And thirdly, there is also a decline in asset-based fees in the fund management sector. Next, we look at the impact on the insurance companies. The first impact is insurance companies are receiving increasing amount of insurance claims. First, I shall talk about the impact on personal insurance. During this unexpected pandemic, life insurance companies are experiencing an increase in mortality or death rate that was not planned for. Even though insurance companies have actually set aside reserves to cover such losses, however, the unexpected increase in mortality or death rate will definitely deplete these reserves. In some countries, the most serious impact could be felt among policyholders in the age group of 65 or older, which also happen to be the age group which is most vulnerable to the COVID-19 virus. And this group of policyholders have the highest concentration of life insurance ownership, as well as holding the highest value insurance products. Besides life insurance, health insurance also experienced an increase in the number of claims, especially related to hospitalization claims. This is especially true for countries where the government are not fully covering the cost of the COVID-19 treatment. As the incidence rate increases, it is expected that eventually the insurance companies would need to revise their assumptions on the mortality or death rate, as well as morbidity or the rate of sickness. Besides that, it is also expected that liability insurance will suffer due to widespread trade settlement delays, the drying up of credit facilities, as well as rising insolvencies. For example, trade and credit policies are likely to suffer because insurance would have to pay up if their policy holders fail to pay due to events such as bankruptcy. Besides that, bond insurance guarantees will also suffer, where insurance company would have to repay bondholders' principal and interest payments in the event of default of the issuing company. And thirdly, this will also affect surety policies, where the insurance company would have to compensate if the policy holders fail to fulfill a certain obligation, for example, the delivery of a construction project. Besides that, the COVID-19 pandemic has resulted in numerous events to be cancelled or postponed. And this is likely to trigger events cancellation claims. Now, having said that, not all events, especially the smaller ones, are insured. Moreover, some policies have included exclusion clauses against pandemic events. However, some of these insured claims could be significantly large. And one good example is the postponement of the Tokyo Olympics, which was supposed to be held this year. According to Reuters, the estimated insured cost of this event is around $2 billion, including television rights, hospitality, and sponsorship. The next impact is there is a delay in premium payments and policy renewals. Firstly, insurance company is experiencing a delay in policy renewals as policy holders face the loss of income as well as other financial difficulties. Moreover, during these trying times, policy holders are more likely to focus on basic or pure risk cover policies, such as those that only offer death protection without any savings or investment features. Meanwhile, in some countries, regulators have also provided a provision for the automatic renewal of the insurance policy, and a grace period is also given for the payment of premium, especially during the lockdown period, to make sure that these policies will not lapse but will remain in force. And one of these countries is Japan, where the insurance companies are requested to implement appropriate measures, such as by providing grace period for premium payment and policy renewal. The next impact is insurance companies are experiencing declining rate of return. As mentioned earlier, currently we are facing a low interest rate environment, and the decline in interest rate will also affect the entire insurance industry. And this is particularly serious for the case of life insurance and annuity sectors, because they have a large exposure in rate-sensitive products and investments. In fact, many life and annuity insurers have started to recalibrate their offerings, and some have even modified their products, for example, by lowering the guaranteed rates of return on certain insurance products. And as mentioned earlier, currently the equities market are experiencing significant volatility due to the pandemic situation. And this will result in a further decline in the rate of return for insurance companies that have exposure or investment in the stock market. Meanwhile, on the actuaries side, the actuaries would have to reduce the valuation discount rate used to compute the mathematical reserves. And this will put pressure on the insurance company to increase the premium payment charged to their policy holders. The next impact is insurance companies are facing challenges to provide new work arrangements to their employees, as well as insurance companies are also facing disruptions of services to their clients. Insurance companies are facing challenges to provide alternative work arrangements to their employees. For example, employees are required to work off-site, most probably from home, to protect the safety and health of their staff, and at the same time to comply with any office access restrictions, such as those imposed during a lockdown exercise. While at the same time, the insurance company have to ensure that their business will continue as normal. Due to these developments, insurance will have to ascertain whether they can allow their employees to gain access to necessary files and to make sure that there is a safe exchange of confidential information among their employees as they work outside the office. Besides that, COVID-19 has also caused a disruption in the ability of the insurers to provide client services. And this begins with their distribution partners, such as their agents, brokers, and financial advisors, where these distributors are also facing similar risk management and logistical challenges as those faced by the insurance companies, especially since they have to work from home. Moreover, these distributors also have to avoid face-to-face meetings with their prospects and clients until the risk situation improves. The next impact is similar to those experienced by the banking institutions, where due to the COVID-19 pandemic, insurance companies are also leveraging on the digital platform. And it is expected that insurers that have invested in improving their digital capabilities will be better positioned in the short run to maintain a connection with their distribution partners. And this in turn would enable the insurance companies to provide faster and more comprehensive services to their clients. Besides that, the COVID-19 pandemic has also created heightened awareness on the importance of having health insurance products. And this is a good news to the insurance sector because it is expected that there will be an increase in the offtake of digital health insurance products. And the last impact is on the risk management practices of the insurance company. Here, I will talk about two possible impacts on the risk management practices of the insurance companies. Firstly, as mentioned earlier, due to declining return as well as increasing insurance claims, this will increase the reserve requirement of the insurance companies. Besides that, the insurers are also facing declining asset value. And this negative development are likely to have a bad impact on the solvency of the insurance companies. Therefore, the COVID-19 will serve as a good testing ground to check whether the insurance company has sufficient capital to withstand the impact of the pandemic. Besides that, as mentioned earlier, as insurance companies embrace digitalization and automation of their work processes, this will also expose the insurers to larger risk of cyber threats. And this is particularly critical for the insurance sector because insurance companies tend to have a large ecosystem of third-party service providers, which will further expand their exposure to cyber risk. And the last institution would be, what is the impact of COVID-19 on other non-bank financial institutions? Non-bank financial institutions, for example, development financial institutions, are financial institutions that provide financial services, such as financing to a particular sector in the economy. And these are normally financially weaker organizations compared to the banking sector. And it is expected that these institutions will experience difficulties in obtaining funding from the capital markets and other liquidity sources during this time. For example, transitional commercial real estate lenders and independent auto lenders may find it difficult to raise funds using repurchase facilities and asset-backed security issuance. And when these financial institutions could not get sufficient funding, this will affect their ability to provide financing to particular sectors in the economy. And lastly, we looked at what lies ahead beyond COVID-19 and how should the financial services sector embrace the new normal. From our discussion today, I'm going to pinpoint 4 possible areas that the financial services sector should focus on due to the COVID-19 outbreak. Firstly, as we have seen, due to the outbreak, the financial services sector begin to digitalize their offerings and work processes. Therefore, banks should continue to adopt innovative approaches to digitalize their processes and offerings. Similarly, insurance companies should also continue to digitalize their work processes, for example, in processing claims, renewal of policies, as well as other policy administration processes. Besides that, the financial services sector should invest more in artificial intelligence or machine learning. For example, to provide round-the-clock customer service or consultation, especially when it is not possible to provide face-to-face communication with their clients. Thirdly, the financial services sector should also invest more in providing contactless-based technology to their client. As the COVID-19 outbreak has highlighted the importance of avoiding human contacts or to have minimal human intervention. For example, financial institutions could offer more contactless smart cards, such as through the mobile or smartphones of their customers. Now, as the financial services sector embrace digitalization and greater advancement in technology, it is also advisable that they look into their risk management practices, where, as mentioned earlier, as this financial services sector move towards digitalization, it will expose them to greater threat of cyber security. And therefore, the financial services sector should look into ways to improve their security system to safeguard them against any cyber security threat. Besides that, the financial services sector should also prepare themselves, for example, in terms of the strength of their capital, so that they are able to withstand any catastrophe in the future, such as those posed by a pandemic. And that's all for my presentation. Thank you.
Okay, thank you, Dr. Chow, for the great presentation. It's very interesting because you combine all what happens in the global, including Italy, China, Japan, Europe as well. So you define how the financial sectors may be affected by the COVID-19 into big four financial institutions. The first is the bank, the investment sector, the insurance, and then the other financial institutions other than bank. And then you give some points. So let me check the chat box first, if possible. They have asked. So here we got one questions. So let me just jump to the questions first, and then I will summarize at the end of the meeting. Adrian Pangestu from BINUS University, student of BINUS, he is asking about Trump urged the Fed to adopt negative interest rate, but the Fed doesn't seem to agree. What is your opinion about it? Does the negative interest rate could bolster the economy, especially the financial institutions? Thank you. I guess you can just directly answer these questions.
All right. The question is whether should we impose a negative interest rate?
Yes, by the Fed.
All right. On one hand, of course, for businesses and also those deficit units in the economy, they would like to see a low cost of funds, all right? Because this would mean that they're able to access to cheap funds. But at the same time, the question is, what is the impact on the financial institutions? As I have shown earlier, as interest rate becomes lower, this will not be favorable to the financial institutions because it will affect their net interest margins, okay? Right, even though they're able to get access to low cost of funds, but at the same time, it would mean that when they want to lend out the funds, they would have to do so at a low interest rate. Unless banks are able to stimulate loan growth to compensate for the lower return from from providing loans to their borrowers. Did I answer the question, Dr. Shinta?
Sorry, I mute my speaker, but I was talking. I was talking to myself then. Yes, you answered the questions very clear because like lowering the interest rate itself, it helps like many people, let's say the borrowers, they don't need to pay a higher cost, and this is how to get normal in these situations. And thank you, Adrian. I guess it answered your question. So we can conduct to the next questions from Alexandra Morgancho, a student from BINUS University. He asking or she is asking, what is the long-term impacts toward fintech companies after this pandemic is over? So she is asking about fintech companies, like how it impacts to fintech companies, because fintech itself is like they're newcomers and they need to adapt with this pandemic situation. Your time, Dr. Chow?
I would see that it could be an opportunity as well as a threat for the fintech companies. Like what Dr. Shinta have mentioned, on one hand, they are newcomers, all right? Yes. And currently, this is not a very good time to have new startups because there are many challenges faced by the business environment. On the other hand, as I've mentioned earlier, those institutions that practices digitalization of their offerings or services would be in a better position, right? Because we are trying to avoid human contacts and we want to do everything online and using the digital platform. So that could serve as an advantage to the fintech industry. So it can be both an advantage and disadvantage.
Yes, because like for the fintech company itself, once like I can explain for like one of fintech company in Malaysia. I know they used to provide the services for transportations, parking, but now the conditions that we are not allowed to go out, we are not allowed to conduct direct interaction. So now they are building another product for contactless, like e-commerce products. So
Yes.
it's opportunities as well as threat, because they got lost in this transportations and parking itself. So I think this is like an example from your explanations. So this is we can jump to the third questions, I guess. Let me see. There is before about the interest rate, and then fintech companies, and now from the insurance industry. Yanita Mustika from BINUS University, I guess, as we know, some of the insurance industry modified their products and services by lowering the guaranteed rate, which led
Sorry,
to another
lowering the what rate? Sorry.
lowering the guarantee rates,
Yes.
which led to another risk. So what do you think about it? Does lowering the rate is effective for the company as well?
Is this based on what I've mentioned earlier about how some life insurance are lowering their guarantee rate?
Yes.
I presume so.
Yes.
And because the insurance company, because they would have to do that, because as I've mentioned, currently they are facing declining return, right? And when they're currently facing a lower return, it is not possible for them, especially to offer guaranteed high rate of return. Okay, so they would have to compensate for their low rate of return. But at the same time, of course, this may cause some unhappiness among policyholders. But then again, if you look at the overall worldwide scenario, okay, currently rate of return in all forms of investment have been declining. So I think policyholders should be realistic about this situation.
Yes. Yes, that's very true. I guess because you also have mentioned it in your presentations before, so you make more clear now. And then there is from Agustinus, he's asking about how about the condition in Malaysia itself, like how long it takes to embrace the new normal in Malaysia. Is it possible to start now in these conditions, or like these lockdown conditions?
Start what? Sorry, what was the question? Is it possible to start?
How long it takes to embrace the new normal in Malaysia? Is it possible to start now in this condition? I guess like to start the new normal activities now. It's possible to do it now or not?
All right. We have been under restricted movement for slightly more than 2 months now, right?
Yes.
And I think every day our government has been trying to educate us, right, on what are the safety measures and the new way of living under this pandemic condition, right? Some maybe easier to educate, all right, where we are trying to be safe and to practice safety measures in our daily lives, all right. But some of the public would need further education, because
Yes.
some may not be used to restricted freedom, and there are so many measures they have to take, right, as compared to the days before the pandemic. Yeah.
Yes, that's very true. Because like the lockdown situation itself, it depends on how the country react and how the people itself react to the condition. Some may react like positively, some may react negatively, and now it's kind of headache to face it, as maybe 2 months takes too long for them to stay at home, but somehow 2 months seems it's not that long. We are doing fine here. Like, okay,
As long as you keep yourself busy, I think.
yes, keep yourself busy, because still at home you can still be productive, I guess.
Yes, yes.
So We have several questions from BINUS University now. I guess it's better for me to take questions from Taruk. I guess it's very honor for them to ask. So it's Kong Jen Ho from Taruk. Hello, from your presentations, the financial sector is facing a lot of unprecedented issues. I'm now in my 3rd year and I was planning to work in the investment banking sector. Is this still a good choice to do so? So I guess he's a 3rd year student planning to work in the investment banking sector, while the investment banking sector is falling down currently. So how do you think so? What is your suggestions?
Well, currently the investment banking sector is facing challenges. One is because there are now currently less company activities, right? For example, companies that want to issue IPOs or raise funds. And as I mentioned in my slides earlier, this has affected, for example, fee income, right? From the investment banking industry. It is a very subjective question because on one hand, all of us are wondering how long will this pandemic last, right? And that will affect, will determine how severe is the impact on the financial services sector, right? But nobody can tell for now, right?
Yes.
Nobody can tell for now. So as I mentioned earlier, it depends on how long the pandemic will prolong, right? And whether each sector in the financial services industry, what measures that they can do to overcome this situation. Like what you have mentioned just now, like in the case of the fintech company in Malaysia, when you face obstacle in one area, you have to innovate yourself, all right, to come out with other business solutions in order to sustain yourself. So I think to this particular student, it's really up to you because we can't foresee, right? What will happen to the investment banking sector. It's up to them how they want to innovate themselves.
Yes, that's very true because we can't. We are in the conditions of high uncertainty, and we cannot guarantee for the conditions. We don't even know when this pandemic will over, and we just hope that it will come back to as usual as well. So I guess I will take this as the last questions as we are running out of time. Dr. Chow's another questions from Taruk, Sally. She is asking, from the announcement of Malaysia Prime Minister, the conditional movement control order has announced for months, and Malaysia had a reduction in national gross income near to 2.4 billion every day. Will it affect our GDP severely? Well, what will be the effect to the country as a whole? How could new normal be adapted effectively? Actually, she asked some questions, so let me take some points. So she's asking about how will affect to the GDP. It will affect severely or not? The first questions, and then the second questions, what will be the effect to the country as a whole? So I guess the GDP for the Malaysia and then the country as a whole. And then the last one, how could the new normal be adapted effectively? So that's the 3 questions from her.
Okay, the first question is, as our country has gone through MCO, or every day it is true that the government has to spend a lot of money, right, to support the economy. But now we are slowly relaxing our control measures so that we are able to allow businesses to slowly resume their operations. Okay, and this is intended to cushion any more severe impact on our economic growth and GDP, right? So it depends on how fast the business activities can pick up and whether we can soften the impact on our GDP. But definitely there will be some implications on the GDP But as I've mentioned again, it also depends on how fast we can move to recover the losses that we have suffered while we were going through the MCO. Yeah, that is I think the first and second
questions. For the second is the effect to the country as a whole.
As a country as a whole, that's a very broad question.
Yes.
I mentioned from the economic side, right?
Yeah,
okay,
yeah.
that we are trying to allow our business activities to resume, all right? So hopefully that will help our economy to pick up again. Yeah. So I think that is economy side of
Economy side, okay.
Yes, all right.
And then the last one, how
it
could
sounds
the
like
new
a
normal?
previous question, right? On the new normal. How do we? Sorry, what was the question again?
How could the new normal be adapted effectively?
I think this has been highlighted by the government that they can educate us, but eventually it is up to each citizen, each public, right? Each person to have that awareness and to have self-discipline, right? Because we have to take care of ourselves, right? And to be aware of the risk that is around us. So if everyone takes responsibility of our own self, then definitely we can embrace the new normal. Yeah.
Yes. If I may add just a few brief explanations, we can actually the pandemic itself start from Wuhan, because I stayed in Wuhan for 4.5 years, and then I was quite surprised seeing these conditions. And Wuhan it's not Wuhan but province Hubei, and Wuhan is the capital city. They locked down since at the end of January, and on the beginning of April they start to take out that lockdown and they start to be normal. It's one of the things that I could learn from China itself. They are very disciplined. It's not only the government, but all the citizens are obeying the rules. So they solve the problems now. So now one last question that also related to this, like self-discipline. It's about the herd immunity from Eureka. Herd immunity. It's about the herd immunity. So she's asking, like, we know that we are facing the real deal, but there's also some people who don't realize or even don't care about this pandemic. So the worst case might be herd immunity. What if the new normal means herd immunity being implemented? So because I guess Indonesia itself is going to face this kind of situations. It's about the herd immunity.
Is it about people not caring about the situation?
It's like, so the people are not, they don't care the current situations. They still go outside. So, and like just nowadays, the government of Indonesia, they give a new announcement that people under 45 may start to work outside while the condition is not still effective, and somehow we are still scared to go outside. Then this is one of the conditions that we know that the herd immunity, like instead of staying people at home, so they let people to go outside to keep doing the activities. So what do you think about this herd immunity?
So it means you're saying to allow people to go out, is it?
I mean, like, kind of, because like herd immunity that we start to go out, even the situation is not normal.
Whether there will be fear among people to go out?
Like how the new normal means herd immunity being implemented. So how to implement the herd immunity itself?
I would think that if you want to allow people to resume their daily activities, right, there has to be proper standard operating procedures, SOPs, right? For example, if you want to allow people to go back to work, there must be proper procedures on what are the safety measures that can be taken to ensure that there will not be infection cases when people go out. Yeah.
Yes, I guess because like we should follow the protocol itself. It's like we can no longer ask the government to keep us, but the discipline, the awareness should should have from ourselves itself. So
Yeah.
thank you so
SOP. Yeah.
yes, the SOP.
Yeah.
So thank you so much, Dr. Chow, for the explanations and the Q&A. I guess we get more than 5 questions, I guess. So I guess we may close the Q&A questions here. If you don't mind, may you share the PPT to us?
You're
The
asking the
PowerPoint. Yes, like
you,
you can send the PPT.
sure. Can I send to you? Maybe you can send an email to me. Yeah.
Okay, I will send the email to you and you can send to me. And then
Sure.
I guess, yes. Okay, so before I close the sessions, I would like to tell several notes about the summary that Dr. Chow has explained us. It's a very outstanding presentations because she provided us such an insightful about the conditions, especially in the financial industry sectors. So she's explaining about how the COVID-19 may affect the financial sectors in four industry. The first one is the banks, investment companies, insurance companies, as well as other non-bank financial institutions. For the bank itself, they may decline the bank profitability, and then also there is also the decreasing of interest rate that she also mentioned and explained again during the Q&A. There's a temporary suspension of loan repayment because people are now not really stable due to their income are decreasing as well. And then Malaysia and Italy are two countries that may, adapt with these conditions. And then for Italy and China itself, they are the country that are most ready to apply the channels and digitals. And then for the investment companies itself, the stock market are decreasing very. They're very volatile now. Even there are several stock markets which is like Dow Jones, the CAC from France, from Germany, as well as from Jakarta itself, and from Malaysia. They are declining. They are showing decreasing very high. And then for the insurance company itself, they should also need to renew their claims because it will have an increasing insurance claims, and the government doesn't fully cover the COVID-19 itself. So it may impact the delay in premium payments as well as renewals. But Japan itself, they implement an appropriate measures, and then also it may affect the declining rate of return. And then the last but not least, for the other non-bank financial institutions, they are facing difficulties in accessing funding from capital markets and other liquidity sources. And beyond the COVID-19, what may implement that the AI itself, the artificial intelligence, the contactless technology, digitalizations, and risk management. So I guess Dr. Chow has explained a very great presentations. So as it's already 2 p.m. now, thank you so much for Dr. Chow and all the doctors from TARU who joined to this international webinar. It's our pleasure to have all of you here, and as well as for the participants. We hope that the conditions will recover soon so we can do our activity normally again. So I will return this time to the MC, Ignas. Thank you.
Okay, thank you, Dr. Chow Yee Peng and Ibu Shinta for the insights. I believe this presentation helps us understand about the situation better. Now we will have the symbolic handover of the certificate by Bu Arianti Puspokusumo as a representative of Accounting Study Program BINUS University. Please proceed, Bu Arianti Puspokusumo.
Great pleasure to give for you to have given your expertise on COVID and its impact on the financial service sector. Have been very, very active, and I think it's really nice to listen to session so that the student can learn what would the impact after the new normal later on. And to Dr. Shinta, thank you very much for hello,
Yes.
Dr. Shinta.
Yes.
Yes, yeah.
Yes.
To moderate today's session, it's been
Yes. Thank
also
you. Thank you
a
for
great
having me as
effort.
well.
Yes, you're welcome. You're welcome. And again, back to TAR University, Dr. Chin. So with this,
Okay, Jonathan, could you please share the screen?
Okay, go.
Dr. Chow and Dr. Shinta, here is the e-certificate for you. Thank you for sharing knowledge with us. Thank you for become moderator for us. Hope
Pleasure.
that we can collaborate in another seminar.
Yes. Thank you so
Please,
much.
one more for Dr. Shinta. Yeah.
Thank
Okay.
you.
Okay.
Thank you for
Thank
having
you.
me, and have good luck for the next webinar conducted by Accounting Study Program as well.
Thank you, Dr. Shinta. Okay, Ignas.
Okay, great. And for the last part, we are going to have a digital photoshoot session. So please make sure to turn your cameras on. Koino, can you please take the picture?
Okay, please, everybody, would you mind to turn on the camera first? Okay. Okay. Wait, let's wait. Okay, it's gonna take some time. Yeah, wait. Okay. Let's start from the first page. Okay, 1, 2, 3. Okay, wait. Okay, second page. 1, 2.
Okay, thank you, Koino. Well, that wraps up our international online seminar. On behalf of Accounting Study Program BINUS University, I would like to thank Tunku Abdul Rahman University College, Malaysia. It's such an honor for us to collaborate with you. Also, I would like to thank Associate Professor Wong Hua Kiong, Dr. Chin Mui Yin, Dr. Chow Yee Peng, Bu Arianti Puspokusumo, Pak Kevin Deniswara, Bu Shinta Amalina H, committee, and all of you for making time in your busy schedule to join us today. Finally, I would like to apologize should any error in name and position spelling. It's been our pleasure to host this event, and I wish you a pleasant day. See you on another event. Stay safe and stay healthy. Bye-bye.
Bye. Thank you. Thank you, Dr. Chow, Dr. Wong, Dr. Chin, and from all Taruk University. We could have more time later.